Welcome to the podcast where we discuss all matters financial planning and investing. This content contains general information only and may not be relevant to everyone. Please contact our office to make sure and determine if this is relevant for you. Hi, and welcome to the podcast. Today we're talking about the stock market crashes and really 5 things that you need to know about them. And before we get onto that, I'm joined with my co-host, Col. How are you, Col?
Good, thanks, Dave. Yourself?
Yeah, very well. So today really, getting into that thing, the share markets have been coming down over the last probably 2 weeks. It happens really fast, doesn't it? I always talk about the share markets catch the elevator down and take the stairs on the way up. But a lot of the time, really the market cycles are really inevitable. And what have you found? What have you seen happen over the history?
If you look at the charts, long term, go back to when, data started recording data. Yes, the market always goes up and down, but history always tells us that when the market does go down, history tells us that it does recover, it does go up. Depends on obviously what's driving the downside and how long that recovery takes. But history shows that it always comes back again.
Yeah, the cycles are really strange. Like from my trading days to basically the markets are going sideways for a long time. So what I mean by that, they're in a short trading range, don't go up much, don't go down much, don't do much. And then when all of a sudden activity happens, like it's happening over the last couple of weeks, obviously it was sort of the Mr. Trump has got, had his 2 bobs worth and really unsettled the markets. And they've come down really quickly. And then, it'll sort itself out from here where it wants to go. But we're coming down from all-time highs. So generally, they're going to get some sort of correction or pullback because they've been running in the 20% gains for a few years. And that's really, it just can't continue like that. It's just, that's the reality. And something causes it. And that can be through recessions or it can be called through like Mr. Trump and all those sorts of things. But what I've been through the cycles and, I think it's from back even in trading, it's very easy and it's a comfortable ride when the markets are going up, which generally is 75% of the time. And then the other 25% of the time, the markets are actually coming down. Like if you look through history, sort of 25% of the time, if you bring it back to the years, in the last 20 years or 20 years in general, 5 years will be negative. But, the other 15 years it's positive. And there are different, things that happen there, but it's how far they go up, but also how far they can go down as well. So, a lot of people are not used to the markets, going down as fast as like the last one. What was the last one? COVID? Really pulled it down. And, and then from 2021, the markets were going, how far long ago was COVID?
2021.
And just how fast the markets recover and all those sorts of things is really interesting. But, the markets are always doing something. Generally going sideways and sometimes going up and sometimes going down. And how we all feel about how those sort of market activity happens is really interesting. How, generally I won't hear from my clients in up markets ever. Very, very, far and few between. But when the market's going down, we've always got a few that are really nervous. And, it's just understanding that the cycles in the market, they're going to happen. And it's something that you try to get comfortable with being uncomfortable. I talk about it's like, and as your experience grows, every drop and every rise, your confidence rises a bit to say that, the market will continue or what have you. So, what are sort of, emotional investing really can lead to potentially mistakes? What have you seen people?
The biggest mistake is obviously of the last few years, we had really good, strong markets. People wait and they get in at the high, and then at the first sign of trouble, they get out. And it's just, it's just not being, like you said, is that comfort level is someone who's perhaps hasn't really invested much in the share market. They see things are going well, then they get in. It's like the whole FOMO thing, let's get in. And then as soon as the markets go down, it's like, oh, what have I done? And then they sell. So it's always buying and selling at the wrong time because they just get too much emotionally involved in the ups and downs.
Yeah, it's as much as you tell someone, look, these things are going to happen. I call it emotional intelligence. Until you've actually experienced it, the share market is a different beast. So generally, people have bought houses and so forth that we've dealt with. So they've seen, they've bought the houses, and generally they've gone up in time, and they don't perceive that that's got a value each day. So it's a different asset class when it comes to the share market, because you could sell it in that day, and your shares have an actual value in every single minute of the day,
Yeah.
it's much harder to really understand and comprehend that and not hit the button to sell.
So
So how many people, I've spoken to that have, five or ten or $20,000 worth of share and made really bad decisions around that just
yeah.
because they get emotionally invested and they want it to do so well that it just makes them make bad decisions.
Yeah.
And it's a really hard thing to do. So one of the things, the mistakes that I've seen, and it's happened to a lot of people, is that, and lucky enough, touch wood, never happened to any of my clients, is that when the markets have had a correction or we've been in GFCs and those types of things, people have sold out, put the money under the mattress
Mm.
and stayed out of the market, and then the market's risen
Mm.
and they've been out of the main trading days, and it doesn't take many trading days to be out of to actually cost yourself a
Yeah.
fortune. And the other thing I find a lot of them do at different times is they crystallize the losses.
Mm.
So the share market, even when it's gone up, you haven't made anything because you haven't sold anything.
Yeah.
And when it's gone down, you haven't lost anything because you
Yeah,
haven't
that's
sold
right.
anything
That's
again.
right.
So the idea of the share market, and what I always talk in, is building them up in units. So compounding interest, you're adding money to the investments themselves generate money. It's getting bigger and bigger and bigger. And over time, it will go past the previous high, which it's always
Mm.
done in history. So it's just, you've got to sit and wait, and making decisions of emotionally is one of the hardest things. And, I learned it from a young age, sort of being like, I've been in the markets for a long, long time now, I'm showing my age, but I've been through all the cycles. It's not that, what I understand is that it will go up again because I've experienced so
Yeah.
many times, but making decisions on, how you're feeling at the time, I'm always like, just sleep on it. Well,
Mm.
sleep on it for a week or put your head in the sand or
Yeah.
one of those things, because professional investors invest for a long time. They see these opportunities when the market goes down to really probably take advantage of it rather than
Mm.
be concerned about sort of,
Yeah,
their
and it's just understanding
wealth.
what you're invested in. Like you go back to the GFC, and I always remember, like CBA were trading at $60 odd. The market crashed, went at $20, but it didn't take long for it to get to back up to And at the end of the day, like you said before, nothing's really changed. CBA is still one of the biggest lenders. The bank is still strong, one of the big four. Like nothing's really, the company is still solid. Just the market reacts to information and so understanding what you're invested in. It's not like you've invested in some, use example like crypto, it go from, go up to 300% overnight and then drop down to zero overnight. So
Yeah,
it's
yeah.
just not that type of thing. So yeah, I think that's if if you understand that, what you're invested in, then it might give you some comfort. But like you said, it's hard for, if you've never experienced before, to see the value of your investment fall, and thinking, and like you said, it makes the wrong mistakes. Like, when do you sell? Well, we don't really know when to sell. And if you have sold, when to get back in, because you keep going, oh, I might go, and it keeps going and going and going. And then eventually, like you said,
Yeah.
you've just sold in a lot higher than what you sold out at. So
Yeah, I think COVID's one of those things. The market only dropped, I think it dropped, it was extremely fast.
Yeah.
Within a month, it had dropped 35%.
Then
Sort
it
of at
came
one
back so
stage.
quick,
It
yeah.
came back within the next month.
Yeah.
Like if you sat on the sidelines,
Yeah,
you're
exactly. You
scratching
missed
your
all that,
head. But also, over time, I remember when Commonwealth Bank went down to about $20 or
Mm.
whatever, it was 60. I was like, this business hasn't changed.
Yeah, exactly.
I'm
Yeah.
like, well, just put your house on it.
Yeah,
Right? So
yeah.
there are different golden opportunities, and we've got some funds that we use in. You see those opportunities come and go, but over time, if you stick probably to the strategy, whatever your strategy is, the worst comment I hear from anybody is, "I'll put some money in and see what happens."
Yeah.
I hate that. I was like, what do you mean you'll see what happens? Like, this investment vehicle will work for you if you use it correctly,
Yeah.
or it won't if you don't.
Yeah.
Do you know what I mean? So if you put some money in, 2 weeks ago and the market went down, your experience would be as totally negative.
Yeah.
When if you've done them at the right times, it could be totally positive. So the markets that it is what it is, and understanding the sort of the cycles and the mistakes that you potentially can make. That's where I think, when people invest themselves and they start off small, I always like that scenario until they've built up the resilience against when things go down. How are you going to react?
Yeah.
Because what you say to me today is probably going to be different to what happens. Like,
Yeah.
give you an example. One of our clients started with $1 million, top of 2021,
So,
all
right.
times, right? And his portfolio was down, probably 150 grand, 180 grand, is probably at the worst particular time.
Mm.
And go forward to today, it's sort of got up to that 1.3, 1.4 million. So it
Mm.
totally turned
Turn
around.
around.
But
Yeah.
if he at that particular stage said, you know what, I'm out, I'm down 150 grand or whatever, and I really spoke to him before we sort of put that money in there
Yeah.
that these things could happen, and they do happen.
Mm.
And over time, it's built up, and yeah, you know, he's obviously in a good position now, and
Yeah.
going through the next one. So now that
Yeah.
the market's moved back a bit, it's not a thing that, oh, you went through it once, it's not going to happen again.
Yeah.
It's continuous,
Yeah.
right?
That's right.
She rolls on, and also, you know, there's probably a lot of people. It's distinguishing now. Are we in a market correction or crash, or
Mm.
are we in a recession?
Well, everything you read suggests that it's not a recession. It may lead to that. So if you go back to the example of Trump and what he's doing, and he said there'd be a bit of pain to come, and some people, some experts in America saying it's going to lead to a recession. But at the moment, it's like you said before, it's the market's had some really good years, and then at the end of the day, some people take profits, and we've got more sellers than buyers. You expect the market to come back a bit. So could be a lot of people just taking profit, but like you said, it could lead to something else. But you all the information, all the stuff you read today, it's all about the economy is, you know, quite strong,
Yeah.
in good shape. So it's at the moment, it's like you said, it's just a pullback.
Yeah, it's a crash. So that's when a lot of people, like, you know, the world's, you know, finishing and all those type of things. With the economy in America, nothing changed really in 2 weeks.
No.
Like, things will change from the, you know, from his tariffs and everything he's putting on now. Whether that will be negative in the short term and positive in the long term, who knows?
Yeah.
It's unproven. And also, like, he's trying to bring back the person sacking a lot of people, and you know how Trump is, and he doesn't stop, and he likes to tweet about it. So, but we won't know for 3 to 6 to probably 12 months if what he's doing is working or not working.
Yeah.
But America, and probably like a lot of countries around the world, can't keep going on the status quo. That's why a lot of people, you know, America's printing more money than you can print.
Yeah.
And that creates problems in general. So their spending's out of control, and that's what he's probably
They're
trying to pull
run
in.
it,
And but he is a deal maker. So, and we're chatting on it before, is that with these tariffs, he's trying to find a win-win deal. You know, there's a few countries and so forth that he's definitely harder on than others, but we'll see it. We'll see how it plays out. But right now, it is just really a correction. We're at all-time highs.
Yeah.
And a pullback in the market of 10% is not such a big deal,
Yeah.
even though it feels uncomfortable. And I even know myself going through the last couple of weeks, it's an uncomfortable feeling. But it's like, you know what, it'll plateau out, go sideways for a bit. You know, we might have a bit of more downside, but then eventually, when it's 1 year, 6 months, 2 years, it's going to go higher than it previously has. You know.
Yeah.
So it's just really important, I think, for a lot of people to understand is that the share market is made up of companies, and generally the companies are doing all right at the moment. You know what I mean? It's not like a GFC when, you know, all the in the US, all the mortgage, the crisis was everywhere, banks going broke, and, you know, this incredible, that went on for a couple of years, and that was very painful, and it took a while to recover from that one. And hopefully we've learned lessons from that, you know, over time. So, but also, so opportunities come with every downturn.
Yeah. And we'll go back to the CBA example again. If you had bought, you know, CBA $20, and like I said, it didn't along with recover again, and you mentioned about, you know, buying units. I used to say to people, it's like, it's almost a silly analogy, but you say it's like CBA is almost on sale. Like, you know, it's a strong company, you know, it's down $40 per share, but you know, it's still a strong business. It's like, why wouldn't you, like you said before, throw your house on it? Because it's, you know.
And by the way, we're not saying this, do that. You get some financial advice before you do anything like that, right?
But yeah, so it's understanding if it's a good solid business, and like you said before, it's the strategy. It's just if you can invest during the downturn, you're getting more bang for your buck, I suppose. You're getting more units, more shares for your dollar per dollar you're investing. And when the market does recover, then you know you're better place to take advantage of that recovery. So it's sticking to the strategy as long as the investments are solid investments. Then it's a good opportunity.
I find you know, even with our smaller investors and bigger investors, it takes time to get a volume of money before that the share market helps a lot of people a lot. So like if you've got 100 grand invested, for argument's sake, like these ups and downs are not such a big deal. And over the last 12 months, all of our clients are in front anyway. Like if they've been invested for 12 months, they're still up sort of around the 8% mark, even though with the downturn. So it's like, it's not, you know, the world hasn't
still
stopped,
doing all right.
It's still doing all right. At this stage, things could change. But it's more about the opportunities of as your investments get larger in value and they're producing more income, and then hopefully you're adding more money to those investments over time, so that your shares in anything gets more and more and more, and over
Yeah.
time that will go up. That's where I find the accounts explode.
Mm.
So it's being patient, of keep adding and keep stacking the money into your investments month after month after month, and that's via your super, could be investments outside of super,
Yeah.
all those type of things. And then it's an extraordinary opportunity to get into quality investments that are on a discount at this time, because
Yeah.
they are going to go higher. It's like when the markets, as Warren Buffett says, when everyone's happy, be fearful, and when
Yeah.
everyone's
That's right.
fearful, you
Yeah.
start buying.
Yeah.
Basically, what he's talking about. And for the last year, I've probably been uncomfortable where the markets
Mm.
are, and they're going up. So I know there's some sort of pullback. You just don't know exactly when,
Yeah.
because the risk of missing out on that, or trying to predict it, it's happening. The market go up another 20% before it
Similar
pulls
to that.
back.
Yeah.
So you actually missed out on that gain, and then all the income that comes with it, and then the more investments and so forth. So, the share market, there's always opportunities in it today, even
Mm.
though it mightn't think whether the market's down, whether it's up, or what have you. What I've found over time, it's your strategy that works.
Yeah. Yeah. And I think Vanguard Investments they've done a lot of research, Marks, and I think there was one study, and it had to do with trying to pick time the market. And I think they took the best 10 days, trading days, and the worst 10 worst trading days over a period of time. And there wasn't much difference, but they're saying it's, like you said, it's strategy, discipline, keep doing it. Trying to time it or pick it is it's very, very, very difficult.
Yeah, it's like I would get many phone calls and say, Dave, is it a good time to buy? It's always a good time to buy.
Yeah.
As long as you're going to be investing for the next 10,
Yeah.
15, 20
Mm.
years, it's going to be a great time to buy, because whatever if you go back and look at the charts,
Yeah.
like 10 years ago or 20 years ago to now, you'd be like, well, it wouldn't matter when we bought,
Yeah.
because they've gone up so much. That's not guaranteed to happen in the future, but what's happened in the past is likely to
And that's an
continue.
important point as well, is understanding your time frame. If the markets are up and you think, oh, it's going up, but people go on to buy a house and I'm going to put in the share market for 12 months because I'm going to want to make money. Well, that's not going to work. May work, it may not work, but it's a risky strategy. So understanding your risk profile, your attitude or appetite for risk, your time frame, and like you said, if someone with not much money, they may feel a drop a lot more than someone with more financial resources. So understanding all that before you actually go and venture into it.
100%. I think I was writing something before around, like, where I see people fail is they try a few things, which is, I don't really like that, the way the terminology, because it's just doomed to fail, and you're going to put more money in generally when you feel good about it, and that's the wrong time to do that.
Yeah.
So the strategy, what works, making sure they're in their risk profile and all those sorts of things. And then just long term, I haven't seen it fail. So it's like, but if your experience is, a lot of the time, everyone's experience is the news.
Yeah.
And it's headlined, oh, the market dropped billions of dollars or what have you, but it doesn't tell you about the day before, which it grew billions of dollars.
Yeah.
It's called the bad news for a reason,
Yeah,
right? It's not
exactly.
the good news channel. And that's just the reality of things when, most people are invested into the share market via their superannuation if they don't have any direct shares. And they will be fluctuating and so forth, but they are risk adjusted for risk, and depending on your age and risk profile and all those sorts of things. So from I think everything we're talking about here, from my perspective, everything that I've seen work is really investors buying for the long term. Whether it's been property investment, share market investment, business. It's like when I see a guy, they say, oh, geez, that guy's lucky, he's a multimillionaire or what have you. And yeah, he got lucky in his 29th year, of working his ass off 15 hours a day or whatever he does. So like, I don't think there's too many free lunches. There are like some very lucky people out there, but I don't really know many.
You make your own luck, don't you?
Yeah, you do make your own luck. So for me, is how you handle downturns. I find it's really important that if you got the long-term view and you're not concerned about where the price is today, look at the history of what's previously happened. And right now, like it is just a bit of a pullback. Unless you invested the money yesterday, it's not such a big deal. Most people are still in front. If they've been invested for the last 12 months or beyond. Have you got any sort of final thoughts on that?
Yeah, like you said, it's the key points are, sticking to, first of all, I think understanding what you're invested in. And if it's good, solid companies, and a lot of people talk about ETFs and that. So, the biggest, well, one of the indexes we use, the S&P 500, the biggest 500 companies. So those ones are, if you invest in something that's like fundamentally sound, then you're right at the ups and downs. And I think you made the point earlier about a property. Because properties aren't valued on a daily basis, there's sort of perception that it's sort of less volatile. And the same, if you look at share price markets, if you look at over 1 month, yes, it looks like a roller coaster. But if you pull back and look over a longer term view, it's, that's much smoother. So I think understanding what you invested in, understanding a time frame, and it's got to be, you've got probably 7 to 10 years at least. And as long as you understand what you invested in and they're good, solid companies, then you're able to ride out the downturns, but also look at that as an opportunity to put more money in those big, solid, strong, fundamentally strong companies, so that when the markets recover, you're taking advantage of the recovery.
Yeah, you make really good, valid points, and a lot of people would be trying to figure out what are those companies. Like, you actually can buy a group of those companies in lots of bunch of things, and if you're not an investor, really get some help around that, because it's a really dangerous area to actually get it wrong. Your hard-earned money, you don't want to be putting it into the wrong things.
Yeah.
Like I've seen so many people invest in different things because they told me that this was going to happen and that was going to happen. I had a client ring me about one investment not long ago. I'm like, why are you doing that? Anyway, he done it, a small amount of money, but I reckon that money's worth zero right now. So there's plenty of, hot tips out there. And it's like when you go to the racetrack, everyone's an expert in telling you they're really dangerous things. But when you're going to, for me, look, we look after a lot of money. And I've got to be able to sleep at night, and I'm not risking anyone's money, like doing silly things that really speculative that, can wipe people out. So it's really understanding how you're invested. Obviously, everyone wants the best returns. No one wants the downside, right? Unfortunately, with the share market, the downside,
you're going to get that.
You are going to get it, because I've just seen so many people say, Dave, I want to do this. And I'm like, have you experienced that before? And if you haven't, I don't want you taking that type of risk until you have experienced it, bring your knowledge up. But I think it's really important just understanding that, the market's pulled back a bit at this stage. We aren't in a recession. So at this stage, it is opportunities for buying, and I'm still buying every month. Nothing is, I get a message from my clients, what are we doing? We're just buying. And as this fluctuation continues, we're going to be buying the next 10, 15, 20 years, or when, however long we're investing for. And this move in the market and the next move and the next one after that, realistically, are not going to hurt you unless you're taking on timing risk or sequencing risk. If you're retiring tomorrow, you need all the money. Obviously, you don't want to be in that type of risk profile that a lot of your money is in the equity side of things. You can get a lot of safety in the fixed interest side of investments these days, and that's something that if people are close to retirement and need money over the next 5 years, it's definitely be looking at. But I think that wraps us up for today. Another episode. Thanks for watching. If you need any help with anything, please feel free to. There should be some links around here on our website to book in a chat. And I hope you have a great day, and talk to you all soon.